Good morning, good afternoon, good evening, everybody. Welcome to another episode of Smokin' Bulls, the podcast about business, money, and lifestyle. I'm Tyler.
I'm Dave.
And today we have the opportunity to speak to Forge First Asset Management. We're joined by Andrew McCreath, who is the CEO of Forge First. We also have John Leong, who is our boots on the ground helper here with Forge. John is a great resource to us and helped bring this meeting together. So I'm going to turn the floor over very briefly here to John. He can do an introduction of Forge First, who they are, and a little bit about Andrew as well. And then we can kind of get into the meat and bones of today's conversation. So John, thanks very much for being here, and I'll pass the floor to you.
Thank you, gentlemen. I really actually appreciate the invite to your Smokin' Bulls podcast. As mentioned by Tyler, I'm the Director of Business Development covering Western Canada, boots on the ground here. And quickly, Forge First is an alternative investment firm focusing on long-short strategies and option strategies to reduce volatility in portfolios. And with no further ado, with over 3 decades of experience in capital markets, from the early days on Bay Street to leading one of Canada's premier alternative firms, Forge First, Andrew brings a rare combination of sharp market insights and disciplined risk management. Also known for his commentaries on BNN and Bloomberg and his proven track record of navigating volatility, Andrew and his investment team at Forge have built a strong reputation for risk-adjusted returns through using the long-short equity strategies. Today, Andrew will be discussing where we believe the markets are headed, and how investors can think differently about diversification by adding alternative investment solutions to their portfolios. So, Andrew, I'll just turn it over to you.
Pleasure to be here. Thank you, John, for the introduction, and Tyler and Dave. It's great to be with you guys. What would you like to chat?
Thanks for doing.
Where should we start?
Well, since Tyler already pointed out we're in Alberta, meat and bones, I haven't heard that one. I thought it was potatoes, but that just proves we're just straight meat eaters here. So I think let's just talk about kind of your strategy, where you can go pretty much anywhere and, try and make a return on both sides of the game.
Well, it's a very good question and a good place to start, gentlemen. But what is very important is one has to stick to discipline and stick to what they know. So yes, that go anywhere comment is correct, but it's go anywhere on the highway that you choose to drive on. And we choose to drive on the medium-sized to large cap public company space in North America. We're not involved in Europe, emerging markets. We're not involved in microcap stocks, nor are we involved in private investments. It's all about being liquid enough so that you can change the speed that you're driving at and staying in the middle of the road such that if you hit a storm, you don't go off the road. And so when we construct our portfolios, we are trying to generate a competitive net return and protect capital when markets get rougher. How do we do that? Well, we go long stocks and we short stocks. What does that mean? When you go long a stock, you are buying a security. When you go short a stock, you are selling stock that you don't own. So you go out and borrow that stock, you pay a little bit of money to the person that owns that stock, and then you go and sell it. And the logic of long versus short investing is best defined by talking about a couple of Greek letters, alpha and beta. Alpha is the movement in the price of a security that is attributable to company-specific factors, whereas beta is the movement in the price of the security that is attributable to the market. For example, if oil goes up $10 tomorrow, you can bet your bottom dollar that oil stocks go up, and vice versa. Whereas alpha is idiosyncratic, meaning that, let's say if we go back 30 years ago and the Real Canadian Superstore introduced President's Choice products, especially those decadent dark chocolate chip cookies, and you wanted them, you shifted stores that you went to. You wanted those cookies because there were so many chocolate chips in them versus Chips Ahoy. And consequently, that enabled the parent company Loblaws across Canada to make more money. Because what happened was, if you go into their store to get those cookies, you put other stuff in your cart also. And consequently, management started to develop a track record of not just growing their earnings at a faster pace than the industry, but also consistently beating the expectations that they told the investment community at the rate of profit growth they expected to have. And so you had a virtuous circle with Loblaws in that the earnings were growing above the market, but you also found that investors were willing to pay more for each dollar of earnings. And of course, that implies a higher price earnings ratio, right? If a company trades at $20 and it's got $2 a share in earnings, what's the PE ratio? It's 20 divided by $2 in earnings, or 10. Well, in Loblaw's case, as they consistently beat their own forecasts for reasons that people increasingly knew, the multiple went up. That was a great example of the alpha. On the beta side, on the alpha side, but on the negative side of alpha, do you remember SNC from a whole bunch of years ago? Remember Bombardier from a bunch of years ago when these companies effectively blew up? And consequently, where there's one cockroach, there's often another cockroach. So that's alpha versus beta. And so what we may try to do is we may go long a stock that we believe is doing better than the industry and hope to generate some alpha. But what if the market goes down? So we may short a stock in the same industry to hedge out the industry beta, if you will. So that's what long short investing is about. And through long short investing, again, we're not trying to shoot the lights out. We're not going to be the company that generates 25% returns if the market's up 25%. But what our goal is to generate a competitive return. And at the same point in time, if markets go down by 25%, as per the comments of our host tonight, we will hopefully make a little bit of money. And so we're going to dampen the volatility in your portfolio, and we will likely be negatively correlated with other stuff in your portfolio, which serves to reduce the risk in your portfolio. And I can say from having chats with Dave and Tyler that they know what they're talking about. They know how to analyze alternative investments, because I have always found that they ask the right questions and they know what those Greek letters means. So that's a little bit about what we do.
That's awesome. Yeah.
It's a good explanation for sure. I mean, within your realm, what are your ranges? What are you allowed to work with? Or do you have a range as far as how long you can be, how short you can be? What do you work within?
Well, I would answer that question with an A and a B. And the A has to do with the rules or the parameters in the prospectus, which is the agreement through which we sell our funds. But B, there's the reality. And I would say the reality is we tend to be no more than 20, 30, maybe 40% net long. What do I mean by that? If you invest $100 with me, I might go out and buy $80 of stock, and I might go out and short $50 of stock. So I would say to you when I'm chatting with you, Dave, well, today we're at 130 gross and 30 net. And so you'd say to me, okay, Andrew. So for each $100 that I invested with you on behalf of my clients, you own $80 of stock, you're short $50 of stock. So your gross exposure, which is your long plus your short, or 80 plus 50 equals that 130% you mentioned to me. And the 30% net exposure is your long minus your short. And you told me that you're 80 long and 50 short. So your gross is 130 and your net is 80 minus 50 or 30. So that's the difference. That's what gross and net exposure are. To answer your question, as I said at the outset of this long-winded answer, although it wasn't as long-winded as answer as the last question, we like to stay in the 20, 30, maybe 40% range. Because if you're running 90% net long and the market gets smacked someday, you know what? You're going to get smacked too. And again, we're looking to be steady Eddie. We're not looking to be, I was going to say the prettiest girl at the dance, but I don't want to be sexist there. I don't want to be the most handsome guy at the dance. I want to just be the guy that consistently gets asked to dance just because he's a good dancer.
Perfect.
Good analogy. Yeah.
See, I'm already off the questions here. I'm not working off my script, but
Okay.
I guess, yeah, well, I guess that's an okay thing overall. So I just think of what we're seeing out there, the Tyler and I, what we go through when we're building out our alternative
Yep.
portfolio. And there seems to be now a proliferation of new ETF long short funds, but I mean, they're volatile. It's like, it's just swapping an equity for one of these. Like, I'm not quite sure I see the benefit buying a long short when it's just going to act like an equity to me.
Yeah, if I can make a comment there, there's a really big mutual fund company in Canada, and it's owned by a bank, and it used to be an independent firm, and they had a market neutral fund. And a market neutral fund means that you keep your net around zero, typically within plus 10 to minus 10% of dollar neutral. Meaning, if I go back to my math, if I'm long $80, I'm also short $80, right? So my gross might be 160, 80 plus 80, but my net is zero because it's 80 minus 80. And the fund that I'm thinking of was a market neutral fund. So it typically ran its net exposure by mandate plus 10 to minus 10%, either side of dollar neutral or zero. But what I found and people didn't realize was that there was a big factor bet in there. So the individual was long high-priced momentum stocks, and they were short the market. So I remember as we were growing our business, I was increasingly getting questions about this fund because, hey, why is this fund acting this way? It's a market neutral fund. I said, well, yeah, it's a market neutral fund, but actually it's not factor neutral. It's long high price momentum stocks, just like somebody else could be long or own deep value stocks. Factor is I don't know, I'd almost say it's an overused word today, but factor modeling, building portfolios around factors is big, big, big business. But suffice it to say, you're right, Dave. When people think they're getting an alternative, you actually have to look under the hood, understand how they construct their portfolios, the rules to how they construct their portfolios, and what do they actually do in their portfolios. For example, you could have a quant fund. In other words, quantitative investing, where the computers effectively drive the decision making. And often, not all the time, those funds trade a lot. And so they might have very high trading expenses, which would be embedded in the expense of the fund. So I hear you loud and clear. And those would be a couple of examples. The last example I would give, and it relates to your specific question, is when you ask about the fund, well, what is the exposure level of the fund? We are allowed to go up to, 150, 200% gross, but some of these funds are allowed to get exemptions from regulatory authorities and run with much higher gross exposure. So if they're running a concentrated portfolio of, let's say, 12 or 15 securities on each side of the book, and they're running with 250 gross, let's keep the math simple. 12 securities on each side of the fence, so 12 longs, 12 shorts, that's 24 stocks. They're running 250 gross. That's on average 10% weight allocated each position. So of course the fund's going to be incredibly volatile. So, I look upon risk as being assessed not by all these fancy terms that people like to talk about, value at risk. What's your VAR 95, at a 95% confidence level. I look at the book and how do you size the names? If you're, 2%, 2.25%, 1.5% long or short names, as opposed to 5, 6, 7, 8, or 9, and you have some hedges, you might perform poorly, but you're not going to blow up. or it's highly unlikely that you're going to blow up. So you got to look under the hood. But again, as I said earlier, like I have found our relationship, both you guys, that, you ask tough questions, the good questions. And, I can tell, I talk to a lot of advisors. I can tell when an advisor, dare I say, knows what they're talking about, or they don't have a clue. And you guys do know what you're talking about. And that's why it's fun to talk to you guys, because it's a conversation. It's not, dare I say, a marketing pitch. You know what I mean?
Yeah. Mm-hmm. Oh, I agree. Well, that's because Tyler took me aside for an hour before this and gave me the brass tacks on how a long short works. So that's why I have all the questions.
We've got a dartboard in the office, by the way.
Nice.
If we kind of take a step back, I guess, and look away from product and look more at, recent volatility that we've seen in the North American marketplace, what do you think are some of the driving factors behind that, just from a, kind of a 100 feet in the air look at it?
Well, there's little question that going into this year, we thought President Trump was going to catalyze significant volatility in markets. Of course, it did for a little bit right after April 1st, but then it hasn't for the rest of the year, arguably because there's just so much liquidity sloshing around the system looking for a home. And while the pitch earlier this year was people are going to leave the States, well, it turned out that, the States continued to be the place to be because they had the companies that were continuing to beat earnings and exhibit rising margins. So Trump was supposed to be the big factor of volatility this year. He played that role for a little while, but for most of the period, he has not. Who knows what next year will bring? I would say the biggest source of volatility this year has been driven by the AI space. Now, most of it's been upside volatility, at least for now. There's no question that there are significant elements of the conditions in the market today, specifically related to technology and more specifically AI, that are reminiscent of 99 and 2000. I mean, when you see advanced micro devices, AMD, give OpenAI a 10% position in their company at 1 cent a share, and there's no revolt by shareholders, I guess because the stock went up when they announced that deal a couple of months ago. To me, I couldn't believe it. There was no revolt. You're giving away 10% of this company at 1 penny a share. When the stock trades at the time it was trading at $200 or something like that. You're seeing these club deals, and increasingly the end point of these club deals, in other words, the element of these club deals that is based upon the data center that may be in Idaho or maybe Alberta, if the premier has her hope, are just not economic. I have seen the analysis that implies how much revenue, how much profit these transactions have to create to make it feasible. But for now, nobody cares. Now, history, it doesn't necessarily repeat. It definitely rhymes. So obviously there's differences between now and 2000 because, these Meg 7 stocks just print money. They're the ones that should be called banks, right? Much more so than they did in those same type of companies in 2000. And that's a good thing. And that can provide sustainability to the market. But there's no question there are worrying signs out there that, I don't know, I'm not, I don't mean insider trading in the sense that everybody thinks of it being as. I'm just talking about, us guys are doing all these deals. And, I'll give you $100 if you take $100 and buy $100 of my products. That's what I'm referring to. Item number 3 relates to the economy. It's looking like inflation's okay in the States, but we're not there yet. We still don't know, in my opinion. And there's so much fiscal stimulus, 6.5% fiscal deficit as a percent of GDP. The Fed is now moving from quantitative tightening, where they shrink the number of bonds that they own, to quantitative easing again, where they increase the number of bonds they own, which of course puts more liquidity in the system. Plus, of course, there's interest rates. But let's leave interest rates alone for a moment. So you've got lots of fiscal stimulus, way more than Mr. Carney is talking about here in Canada. And there has been for several years at those levels in the United States. And now you've got the central bank of the United States, the Fed, who's going to start to print money again through QE. And then there's interest rates. And, the economy is increasingly bifurcated in the States. We're of the view that, 10 years ago, 15 years ago, 20% of the population was struggling. I would suggest to you that's 40% of the population is struggling now, whereas the top 10% have more money than they ever dreamed they'd ever have. So that's what I mean by a bifurcated economy. And the absolute number of people in that 10% is big enough, population-wise, to probably keep the economy going at an okay rate, while the other 40% have even greater difficulty. So I'm not convinced that cutting interest rates is the right thing to do right now. They undoubtedly will. But if President Trump gets his ways, and, he may just appoint half the board to get his ways, he could pump up the volume a little too much and cause a big problem prior to perhaps ultimately there being a problem related to these deals that I am saying are becoming increasingly uneconomic. Tyler?
So we could have the symphony of things kind of happen at the same time, or, be a cause and effect to each other that could cause some pretty dire markets at some point in the future, which we always do end up with something that collides and cascades into a big problem.
No question. I mean, again, one has to be pragmatic about this, not dogmatic. And again, there's so much stimulus right now that it arguably doesn't matter what the valuation of the market is, because it's fact that relative to history, the valuation of the S&P 500 is at the higher end of the range, top decile, in that 90 to 100 percentile. Now, look at the 493 where you take the Mag 7 out. It's still far from cheap. But the valuation does not break markets. Typically, it's an events that, we don't know what they are. We don't know what that catalyst will be. You wait, and that's why it's an event. And that's why, as I find in talking to you guys, you very prudently construct your client's portfolio where you can't buy the insurance after the house floods. You got to buy the insurance before the house floods. You never know when the house is going to flood, but if it does happen, you're protected. And that's the same thing with client money, especially when markets are, in the highest 10% from a decile perspective of valuation relative to history. But you're right. You can't predict that the market's not going to go to 7,500 or 8,000 in the S&P 500. Why? Well, again, there's so much stimulus out there, and the Fed's going to pump up the volume even more.
Yeah, I think that's what we've read is as, quantitative easing begins to take place and interest rates fall, that's, frothy for, your high risk equity markets. I mean, they tend to be driven higher there. So,
if I may, look at Mr. Buffett. What has he always said? When the tide goes out, you see who's wearing a bathing suit, right? And the tide may not go out for 3 years, but it may go out 2 months from now. You just don't know. And that's why you've got to always have appropriate protection in your client's portfolio by holding uncorrelated assets. I mean, meaning that, I'll just make up an example. If a client owns 10 bank stocks, US and Canadian bank stocks, and that's the entire portfolio, well, obviously, if there's a shock to a variable that causes the prices of bank stocks to move, they're very vulnerable. Or you're all gold, you're 100% gold. Same thing, right? Or energy stocks, even better example, right? How many times have investors in Alberta, Saskatchewan, Canada been bullish on energy and they've had their head handed to them? I can think of 2015. I remember when I was out in Western Canada marketing our funds in 2017, and I met with, in one-on-one meetings, CEOs of several energy companies, and their stocks were down. It's like, no, I need to buy more of my energy stock. Okay, fine. Now, of course, they've diversified ever since 22. But it's better to protect ahead of any potential event.
Yeah, I think that's just a diversified portfolio, but you know how people are. They, FOMO, people load up, it's really hard. I think portfolio diversification is hard. It's not as simple as people think. I mean, we might be in that kind of frothy part, and who knows how long everything lasts for, but it's like a fully loaded plane with a runway length. And if that runway length actually isn't what you think it is, that's the wipeout. And so sometimes you just got to go lighter and make sure no matter what happens, that plane's landing or taking off. And I think that's a difficult thing for people when there's this craze going on and we're all seeing it. And that's all everybody wants to talk about.
100%. And it's incrementally difficult today, Dave, because of bonds. I'm not a fan of what they call duration. In other words, long-term bonds, 10-year bonds, 20-year bonds. And so we have stayed very short-term in our portfolio, like as I say, 2 years, maybe 3 years, because I think those interest rates go down, which increases the value of the bond you own. But 10-year bonds, I'm not convinced that those yields go down. I know a year ago, I will admit it with you guys today, I wrote a view that I would have thought that during 2025, we'll see U.S. 10-year bond yields hit 5% before 4%. Well, we're near the end of the year, and those 10-year bonds are 4%. I think they touched 5%. So, a Pyrrhic victory, is that what they say?
You got both.
Yeah. Like a weatherman.
Well, exactly. And we all know, in baseball, if you hit 300, you're a rock star. So, boy, I wish I could hit 3 out of 10 in stock picking and be considered a rock star. Ha, ha, ha. Yeah. But with respect to macro variables, it's really difficult to predict where they're going to go. But I don't like bonds. And as you gentlemen know, and you undoubtedly have educated your clients, during the past, let's say 40 years, up until about 5 to 10 years ago, stocks and bonds were negatively correlated, meaning that when stocks were going up, bond prices were typically going down. And when stock prices were going down, bond prices were going up. And hence diversification was much easier. But the printing of money by central banks globally, let alone to the gargantuan volumes that they have, has eliminated that negative correlation most of the time during the past 5 years.
Yeah,
it's tougher.
Yeah, we for sure saw that in 2022, and you could start to see that happening even before that. And I think that's why Dave and I started exploring the alternative asset space back in 2015, 16 is when we started getting involved there. So our exposure to that style of fixed income was reduced, and using products like what Forge First offers on a long short concept became pretty valuable in market volatility.
Yeah, we have some very good world-class alternative investment managers in this country. There are several of them, and they operate at scale. So in other words, they have a very strong business. They're not going to go away, even if your clients have not heard of them. It's not like, Royal Bank or TD Bank type of thing, right? But we have many strong managers in this country. So that has definitely made your job potentially a little bit easier, given the fact that bonds don't offer you the protection that, your parents used to be able to get from owning them.
For sure. Mm-hmm. No, I would agree. Yeah. What else you got on your list there? I haven't been writing notes like you have. I'm blabbing along.
I'm learning with Andrew's comments here. So that's what I'm writing notes about. Yeah. Doing my KYP.
Yeah, I guess, since we're kind of on this vein anyway, so, traditional 60-40 portfolio, what does that break down in I know you're, a long short firm, and you've got other things. So what's a average portfolio in your mind from equity fixed alternative structure?
Well, I'm going to prove that I'm not talking my own book by pitching an ETF here. So if you go back to March of 2009, and if you bought an ETF and went away to the beach for 15, 16 years, you would have made out like a bandit. But now we're at the other end. Do you want to do the same thing now? No, you don't. Why? Well, while I said valuation doesn't break markets, with the markets trading at, you pick your number, 24 times forward earnings in the States, and some of the items that we're seeing going on out there that I was referring to with respect to AI and large cap tech stocks, it's not the time to not have a properly constructed portfolio. So that, in other words, portfolio construction is cyclical. So back then you could have bought an ETF, gone away. Now we're at the opposite end of that spectrum. You need active management. You need active management by investment advisors that, know what those Greek letters mean and know how to utilize them in constructing a portfolio that meets the goals of the clients, because all clients are different with respect to their needs and their goals. The 60-40 portfolio is fine at certain points of the cycle. As you can probably guess where I'm going here, I would say at this point in the cycle, you do want more alternatives. And I would be taking money out of stocks, and I would taking money out of bonds. And maybe you have a 40, 30, 30 portfolio, something like that, with 32 alternatives. And of course, alternatives is a term that includes all different types of products. It includes private equity, venture capital, private credit. Oh, what's in private credit? Well, private credit could be mortgages. It could be, the company making loans to private companies. And then, of course, there's long short bonds, whether it's like government bonds, for example, or governments versus corporate. So, and then there's the equity space. So alternatives are a very broad term. But your 60-40 allocation, Dave, I would suggest is a cyclical situation. And right now, I would be biased to using more alternatives than I might at the beginning of a cycle.
I was hoping you'd say something like that, because it just kind of supports the way Tyler and I are set up, obviously. Yep. But it's in the last 7-8 years, it's brought the overall volatility down, and it hasn't affected the long-term return. And that kind of is the name of the game. I mean, there are clients that want you to just shoot the lights out, and we don't have a lot of those because it's just hard to do. We're not right. So we're not day traders, we're not stock traders. We rely on the best managers to get us to that promised land, and most of our clients just want a consistent return with less volatility. So can you get that return, get back the fee that you charge them, and get them pretty close to the underlying index that we're using without the volatility? Or without the same volatility. Yeah.
Right. You go to a whiteboard in front of a client and you ask them, which fund do you want to own? Do you want to own the fund that starts there and ends here? Or do you want to own the fund that starts at the same place, but just goes steadily up, grinds higher up and to the right in a less sexy fashion, but it still gets there, and you've slept every night. You've had no fears.
Yep.
Of course, you want that steady Eddie one.
Well, I think our portfolios are relatively boring for most of our clients. We just, when we got a few minutes at the end of a meeting, we let them know they've got a little bit of Bitcoin in their portfolios just to make it exciting. They got to have something to talk about at Christmas cocktail parties, right? So, it's there.
You're absolutely right in that statement you just made about Bitcoin, Dave. But when you think about the word boring, waste stocks, waste management stocks, garbage stocks. And garbage is what you take out to the end of your driveway, not bad companies. Garbage stocks are actually really good companies. They steadily grow their earnings 10, 12% a year in, year out. Recession, no recession. But in a year like this year, where it's all about sex and sizzle and AI, they're underperforming a lot. And, we own some garbage stocks. Why? Because when I talked about factor investing earlier, and I realized I sort of dissed it a little bit, Another one of the hundreds of factors out there that investors consider when they construct portfolios is what's called quality GARP. So you know what the word quality means. GARP is growth at reasonable price. So, you can buy garbage stocks at 14, 15 times earnings, and they have a history of growing their earnings at, call it 12% a year. Some people like those kinds of businesses. Again, it ain't sexy and it's going to underperform certain years, but you're right. Boring is good.
Yeah, but it's easy to get caught up in the AI space.
Well, you can find excitement if you want it.
Right.
Yeah.
Right.
Yeah. If you were to speculate, Andrew, I know it's impossible to say, but you touched a bit on, the overstimulus in the marketplace, but that it's impossible to predict, what throws it off. It's that volatility is there, but you don't know what event is going to cause it. What will be an example of an event that may throw off this big AI run that everybody's on, and where it would make sense, really, like we have to have a product like Forge First in the portfolio to be prepared for an event like that. So what events would throw off the markets right now?
Can you imagine if the Chinese came out with a chip that was better than NVIDIA's Blackwell? Or can you imagine
the one that they had a year ago, or when
that was the big AI chip.
Well, it's interesting. I remember it was 2017, and there was actions taken against the Chinese to block their access to technology, and by the U.S. government. And China's response was, we are going to allocate $350 billion to develop a semiconductor industry. That was 2017. Look where they are today. When you look at the AI space, China versus the United States, I wish I could say Canada, but we can't, right? It's interesting to note that China has more than 2 times the amount of electricity capacity that the United States has. More than double. And when you look at the amount of capacity they added last year, it was equivalent to about 40% of the entire grid capacity of the United States. And within those additions, when you look at their alternative energy, like their solar power, they have more alternative energy than the rest of the world combined. And when you look at the recent fifth plenum out of China a few weeks ago, they're piling in more and more and more electricity capacity. Item number 2, in my opinion, in the United States, it appears to be a situation where Dave, you're Sam Altman, and Tyler, you're Elon Musk. Now, you don't like each other. I'm going to beat you with my AI. Whereas in China, like it or love it or dislike it, fact of the matter is it's Team Beijing. We're doing it all together. We're gonna develop these large learning models. We're gonna do it inexpensively with chips that use a lot less power than the NVIDIA chips, and it's going to be an open system. And so we're going to try and promote it to the world. Who knows what's going to happen? But what I've described to you with respect to the approach towards AI development in China and the electricity, I would say are 2 facts. So it's entirely possible that at some point in time, we wake up with a news item out of China, just like DeepSeek, which, lasted for, 2-3 weeks, I guess, right? But who the heck knows? But what if Microsoft, point B, what if Microsoft and Amazon and Google came out and then Facebook came out and said, you know what? We're not getting the returns. We're going to cut our capital spending by 50%. You think the market would go down? Understatement, right? I mean, these companies are actually strapping on debt now, right? Like sizable debt. And yes, I understand that they generate a lot of free cash. And I want to be clear, I'm not being negative on the stocks. I'm just sort of making a couple of comments as an analyst looking at those securities. But when you ask what could happen, aside from geopolitical events that we know nothing about, the tragic 9/11 situation, right? It happened. We had no idea what was going to happen. Let's just hope we don't have another one of those. But a geopolitical event, or all the big boys cutting their capital spending, or some new technological development. I mean, some folks that John and I talked to on our travels believe that quantum computing is going to put, AI on the shelf. I don't know. It's above my pay grade.
Well,
I know the answer to that.
No, and I think I would probably agree with the cutting the spending. I the geopolitical and one-off are really hard to predict or plan for, but I think seeing a little bit of the writing on the wall, the way you're talking, I mean, they're pouring, like, the bet's on. They're pouring a lot of money into this. They're taking on debt. They're cutting employees. Like, those companies they're shelving people by the day right now to have that capital, that extra capital to make the bet.
Yeah.
And so if that goes sideways, then you got a big problem.
Yeah. And I read a few weeks ago that Microsoft is inventorying some of the chips they're getting from NVIDIA. Why? Because they don't have the electricity capacity to build out what they wanted to use the chips for.
Well, that is the race right now.
Yeah, we've heard the play is energy. Like, really, it's all about, do we have the capacity to support?
Yeah.
We all know that sometimes the facts don't change, but how the investor wants to see those facts, right?
Yeah.
Like, let's say a company that's good, bad accounting, and so therefore you're not going to touch the stock, and nobody seems to care. But then one day, people care, and the stock goes down by 60%.
Well, that sounds like what was that one? Super Micro or whatever. Had a little bit of accounting.
Absolutely.
Yeah, and took a bit of a hit for it. And they're, heavy hardware, AI, trying to compete with Dell for the industrial commercial side of servers, right? So it's, like, in the individual side of stocks, things can happen quickly, but that can be contagious. It makes people start looking around at every competitor they have and go, what's different here?
Yeah, I mean, I remember reading 2-3 months ago how, I believe it was Facebook. Sorry, I can't call it Meta. I believe it was Facebook that extended the depreciation schedule on, I can't remember if it was their servers or chips. Let's just call it the technology they were buying. And some analysts were very skeptical. Why are you extending the life? In other words, depreciating that $100 you spend over, let's say, 5 years, not 2 years, when people say that the shelf life of those semiconductors are only 2 years because the technology is advancing to new generation technology so quickly. But nobody cares. Same with stock-based accounting. We're showing 70% operating margins. Oh, wait, but you're not including the cost of all the free stock that you gave all your employees. You're actually, if I subtract that from your 70% margin, you're actually at a 40% margin. But again, I'm not trying to be a big skeptic. I'm only trying to make the point that I made a minute ago, previous to these couple of examples, where the facts may not change, but the market's okay with it until they're not. And again, that's why you've got to structure your portfolio so you don't have, in my opinion, oversized weight to individual securities. I mean, I have met financial advisors. I remember one team I met several years ago in Western Canada, and they basically had 5 stocks in the portfolio. They're all tech stocks. It was working. It was working big time. But, if it doesn't, you got a big problem.
Mm-hmm.
Slow and steady.
We were just talking about that yesterday. Yeah, we were having a discussion of, how you succession on our book, who's the next manager we're hiring, things like that. And one of the things that came up was when a firm we belonged to merged with 2 firms, big firms, all of a sudden you see the stats of all these other advisors come into the stack and you go, holy, look at this team just rising. And it turned out they had 5 weed stocks in their portfolio, and it just gone from a book of 100 million to 600 million. And it's like gambling with your client's money so you can build a big book and hopefully unload at the top and then build a proper portfolio. It didn't work out, just like you're talking.
No. And I also, honesty is the best policy, and I'd love to bat more than 300. But I mean, we all have good and bad calls. And I talk about being pragmatic, not dogmatic. Well, you know what? I was dogmatic about marijuana stocks back in 2017. I thought, like, why should there be any value to them? Because anybody can grow the stuff. And then, of course, watch them go to the moon. And I had clients ask me, do you own pot stocks? I said, well, no, not really. And I just explained right now why or how I explained to them. And then, of course, a year and a half later, they were all like single digit, if not penny stocks. And, I must admit, I'm amazed that the central bank of the United States allowed Bitcoin to become as pervasive as it is today. Because I know that you have listeners that love Bitcoin, and I'm not trashing Bitcoin at all. Those investors have made a lot of money in Bitcoin, but it is irrefutable that crypto field is rife for fraud and manipulation. And I'm amazed that a central bank didn't sort of butt the cigarette out before it got going, or what was the logic of them not butting it out? Now, of course, it's, as we all know, we have a president of the United States who is very bullish on Bitcoin because a whole bunch of his net worth is tied to cryptocurrencies. But I must admit, I was skeptical and wrong about crypto out of the gate.
Well, I mean, we have it in our portfolios just because we see it as an asset class.
Absolutely.
But what's interesting about it, though, like your comment on that is, I mean, it takes a little bit of play out of the Federal Reserve's book, like your ability to manage your flow of money. I mean, if you've got Bitcoin as an alternative, how do you keep printing your dollar? Like you're going to run into a big problem there without having to adopt more and more of the crypto side of it. Like, it's going to be interesting.
Yes. And think about this for a moment. Who buys a stable coin that doesn't pay a rate of interest? Do you?
I feel like a stable coin's an in and out. Like maybe it's just for the speed of a transaction and maybe save a little bit on that. But why would you sit on a stable coin for a prolonged period of time? If it's backed by a fiat currency.
Remember, Treasury Secretary Scott Bessent, has estimated that stable coins could be a source of $2 to $3 trillion of capital for the U.S. government. I don't think North America will be the buyers at $2 to $3 trillion worth of stable coins. I think it's going to be countries in less fortunate regions of the world, countries where the citizens don't like the local currency. Could be, for example, countries in Africa, on the continent of Africa. And so I have this odd thought that, as you alluded to a moment ago, Dave, a stablecoin is backed by a security. In the case of the United States, it's backed by, 2-year government bonds, federal government bonds. And so I think it's kind of an odd situation where Bessent's pitch, in my opinion, it's not his words, my opinion, is that these consumers in less fortunate regions of the world are going to finance the U.S. deficit because they will buy stablecoins. They don't want the local currency. They want to be in a stablecoin to be backed by the U.S. dollar. And that stablecoin, when they get $1, they buy $1 of U.S. Treasury bonds. And that is going to be a source of $2 to $3 trillion dollars, according to Bessent, in financing the U.S. deficit.
I mean, it is interesting because, I mean, we've all traveled. Now, I haven't gone to some of these really tough regions of the world, but they just want the American dollar in their hand. If they see your wallet come out and you've got a couple American bills folded in the bottom, they're like, no, I don't want to take this currency. I'll take that. Even in Mexico, they'll take an American dollar over a peso because it's stable. So it'll be interesting how this plays out. I don't think you're going to see the everyday American want to build up a U.S. dollar stablecoin unless they're transacting overseas with someone and they're looking for speed and maybe a little efficiency and a lower cost than through their traditional system. But that's an in and out transaction.
Yeah. So 2 comments quickly. One is that I agree with you. The North American consumer is going to want on an asset that gives them a yield as opposed to a stable coin that pays them nothing. Item number 2, with respect to stable coins, is no question, it makes it easier to trade cryptocurrency. And so there is utility in stable coins if you want to be an active trader in crypto. It's much easier than taking money in and out of your bank to buy cryptocurrency.
Yep, for sure. Well, I feel like we can roll with this for a long time here, though.
But we're out of time, Andrew. I know you've got another appointment to get to.
Yeah.
No problem.
I want to thank you for taking the time to speak with us today. If you want to learn more about Forge First, you can certainly come to our website. You can find Forge First online. And if you want to learn more about Smokin Bulls, follow us on our socials. So thank you, John. Thank you, Andrew, for getting this together. And we really appreciate your time.
Thanks, guys.